Well, hello, folks, and welcome to another netplan.com.au update. This time, a really important strategic move on how to save your loved ones more than $60,000 in tax when you finally shuffle off this mortal coil. All right, so to understand what's going on here, we need to understand what happens and what the tax aspects are of your superannuation. Now, you might not realise it because as you're building up your superannuation, inside the superannuation fund, your benefit is broken up into two components. There's a tax-free part and what we call a taxable part. The tax-free part comes out of your superannuation at any time when you can access it, completely free of tax. But the taxable part becomes all important depending on where you are in life or in death, depending on your circumstances. So what happens is that when we reach 60 years of age and we access our super, we kind of don't really notice this stuff because when you take money out of a taxed superannuation fund after turning 60, it's always going to be completely tax-free. But nonetheless, every time you take a little bit of money out, you're taking some of the exempt money, some of the tax-free money, and some of the taxable money. So if you pull out, say, $10,000, it's going to be a portion between how much is tax-free and how much is taxable. So it might be, say, $10,000, $1,000 is tax-free, $9,000 is going to be taxable. Again, because you're over 60, there's no tax payable, so you just kind of ignore it. The tax-free part or the tax-exempt part is made up of non-concessional contributions, which is where you've paid money into superannuation and haven't claimed it as a tax deduction, and also those government co-contribution things, which you can access sometimes if you're able to get the co-contribution with low income levels. But that's basically it. The taxable part includes all the money the boss has paid in as a concessional contribution under compulsory super. It includes money that you might have salary sacrificed to super along the way. And it also includes money that you've paid in personally and claimed a tax deduction for, which is what you can do. So for most of us, the vast majority of the money that's in superannuation is going to be taxable when it comes to the end game. So what happens when you shuffle off this mortal coil? Well, one thing's for certain, the money's going to have to be dealt with. It can't stay inside the superannuation system per se. It's got to come out as a death benefit to someone. Now, the superannuation tax law requires that it must go to a dependent. So you can't nominate your best mate unless they're a dependent. You can't nominate a charity or anything else. It must go to a dependent. The only alternative is to your estate, sometimes referred to in the will in your super fund as the legal personal representative, but that basically means the will takes over in terms of how the money is going to be distributed. Now, these are really important things to understand. If you've nominated a dependent that's a financial dependent, and that's normally going to be your partner, your spouse, or maybe even some younger kids, if you've still got kids living at home, they're classified as financial dependents. That death benefit in totality goes to them completely tax-free. However, if they're not a financial dependent, and that's going to be your adult kids, folks, then they do not receive the benefit tax-free. In fact, when it's paid to them, it comes in as taxable income. Now, through the magic and mystery of rebates and offsets and all goodness knows what, the taxable component ends up being taxed at 15% plus the Medicare levy. So we're talking, 17% tax on the death benefit payout. So that can add up to thousands and thousands of dollars. The other problem with that is that it can upset the financial plans of the loved one that's receiving the death benefit from your superannuation fund. And that's because I said that money comes in as taxable income. That can upset all sorts of things like family tax benefits, paid parental leave, Division 293 super tax, which is basically an extra 15% contributions tax on the money they pay into super. So there's a really easy fix. Simply nominate your legal personal representative as the beneficiary of your superannuation. And that means that your super goes to your estate and is dealt with by your will, and you say who gets what as far as, in the terms of your will. So what happens there? The tax of 15% still comes out. But because the money's being paid to an estate, and that's not a natural person, as the tax office likes to call things, it's a trust in effect, there's no Medicare levy payable, okay? So you're going to save yourself at least 2% Medicare levy by having it paid to your estate rather than to the kids. But here's the other thing. If the estate makes the distribution to the kids, in other words, it's paid via the will and not directly by the super fund, distributions from an estate are normally tax-free. they're non-taxable. They don't even have to declare it. So that's not going to upset their family tax benefits, their paid parental leave, and their Division 293 extra super tax. So a very useful little tip. So again, when you've still got someone with you that's a dependent, you absolutely make sure that you have them as the nominated beneficiary, because it's going to go to them pretty much tax-free. If they're no longer with us, or if you're single, then it's important to make sure that the estate is left to your legal personal representative via, which is basically your will. Okay, now here's the really important thing to understand from this session, and that is to make use of a strategy called recontribution. Now, I mentioned before those taxable components, the tax-exempt and the taxable part. What we want to do is to see if we can lower the amount that's in the taxable component and boost the amount that's in the tax-free, the tax-exempt part, because whenever that goes to your beneficiaries, either through the will or directly, as I've mentioned before, no tax is payable. So how do you do it? Well, it really only works when you're over 60, when you can access your superannuation. And you do it by withdrawing $360,000 or up to $360,000. Frankly, this strategy works with almost any amount of superannuation. But $360,000 is significant, as you're about to understand. You take it out, because you're over 60, it's completely tax-free. So it lobs in your bank account, you give yourself a high five, and what do you do with it? Put it straight back into super. Sounds crazy. But what we're actually doing is making a non-concessional contribution to your superannuation fund. And the reason we've come up with that figure of 360,000 is to be reflective of what we call the contribution caps. Now, if you haven't made use of your non-concessional contribution caps under the bring forward rules, which I'm about to explain, then this is for you. So the $120,000 annual limit is the amount that you can pay into superannuation. But if you haven't made use of it and your super is less than $2 million, you can generally put in up to three future years of super in one lump sum. So that means 3 times $120,000 or $360,000, our magic figure. So you recontribute that, you max out your cap for the 3 years, put that back into super as a non-concessional contribution. It's just boosted the exempt part by $360,000. Significant. What are we talking about? Well, remember that 15% tax is no longer going to apply. So we're going to save, if it was paid to your estate, $54,000 in death benefit tax. And if that money had been paid to your kids directly, as I'd mentioned at the start, they'd be saving now $61,200 in tax, the death benefit tax. So a very, very valuable strategy to follow, something that anyone can do. If you'd like to understand a bit more about how you actually do it and combine it back with an account-based pension, you can move money easily within the superannuation system. There's a lot more on the netplan.com.au program. Now, what's netplan.com.au all about? Well, this is a training program that teaches you how to develop your own comprehensive financial plan. It's not as hard as you think, folks. It's a bit like standing in front of a maze and trying to figure your way through to the other end. At Netplan, we're there to hold your hand and show you the quick way through with all the shortcuts. It's all about knowing how the system works and how to work it to your advantage. As I say, some people want to use a financial planner. That's fine, cost them thousands and thousands of dollars. The netplan.com.au program is designed for pretty normal people to basically design their very own financial plan. Hope you've enjoyed this session. Why don't you rate us? And of course, if you'd like to keep updated, we'd like to put out regular strategic updates for people in Australia about Australian retirement issues, not only superannuation, but also tax and, more importantly, Centrelink, and how to make the most out of what you have. Nick Bruning from netplan.com.au. Thanks for joining us.